What is short selling in Forex? Explains simply the core concept. Short selling in Forex is betting that a currency will fall in value relative to another currency. You profit if the exchange rate decreases. It's the opposite of going long, where you profit if the price rises. How short selling differs? Forex versus stocks. Stocks. To short a stock, you must borrow shares from someone, sell them, hope the price falls, then buy them back cheaper to return them. You pay interest on the borrowed shares. Forex. No borrowing is needed. When you trade a currency pair, you are always buying one currency and selling the other simultaneously. Going long, your USD equals buying euros and selling US dollars. Going short, EUR/USD equals selling euros and buying US dollars. THI is short selling in Forex. Why? Short selling is normal. In Forex currency pairs, every Forex trade inherently involves both buying one currency and selling the other. Shorting is just as natural as going long. Two-sided markets, currencies constantly fluctuate based on global economics, politics, and sentiment. Opportunities exist, whether a currency is strengthening or weakening. No uptick rule. Unlike some stock market, Forex has no restriction preventing you from shorting a currency pair, even if its price is falling rapidly. Market direction. Markets trend down as often as they trend up. Shorting allows traders to potentially profit from falling markets. Practical examples: shorting EUR/USD analysis. You analyze the Eurozone economy and the U.S. economy. You believe the euro will weaken against the U.S. dollar, maybe due to weak EU data or strong U.S. Fed rate hike signals. Place the trade. You decide to go short your USD. You are selling euros you don't physically own. You are simultaneously buying US dollars. Outcome profit. Current EUR/USD rate 1.1000. You sell one standard lot at 1.1000. You've effectively borrowed 100,000 euros from your broker to sell. Later, your USD falls to 1.090. You buy back 100,000 euros at 1.0900 to cover your short position and return the euros to your broker. Profit. You sold 100,000 euros at 1.1000 and bought it back at 1.090. Your profit is $1,000. Outcome loss. If your USD rose instead to 1.110 and you're bought back to cover, you sold at 1.1, bought back at 1.11, your loss is $1,000. Key risks of short selling Forex: unlimited loss potential. Unlike going long, a currency can theoretically rise infinitely. If you're short and the price keeps rising, your losses keep mounting. This is the biggest risk. Leverage amplifies risk. Forex trading heavily uses leverage. While this magnifies profits, it massively magnifies losses on short positions. If the market moves against you, small adverse moves can wipe out your account. Margin calls. If your losses on a short position reduce your account equity below the broker's margin requirement, you get a margin call, forcing you to deposit more money immediately or have your position automatically closed at a loss. Short squeezes. If many traders are short a currency pair and it suddenly starts rising rapidly, they may rush to buy back to limit losses. This panic buying forces the price even higher, causing bigger losses for remaining shorts. Carry trade risk. If the currency you are short pays a higher interest rate than the one you are long, you typically pay the interest rate differential daily. This can erode profits or add to losses over time. Essential tips for beginners short in Forex. Master risk management first. This is non-negotiable. Always use a stop-loss order on every trade to define your maximum acceptable loss. Never risk more than 1 to 2% of your account on a single trade. Respect leverage. Start with very low leverage or none at all. While learning, higher leverage makes shorting exponentially more dangerous. Understand the fundamentals. Don't short blindly. Have a reason based on economic data, central bank policy, or technical analysis showing a downtrend is your friend. Shorting is generally safer when the currency pair is already in a clear. Avoid trying to pick the top and short against a strong uptrend. Start small and demo first. Practice shorting extensively on a demo account to understand the mechanics and emotional aspect before risking real capital. When you start live, trade small position size. Beware news events. Major economic news releases can cause extreme, unpredictable volatility. Avoid holding short positions over such events unless you are highly experienced and have a specific strategy. Monitor swap rates. Be aware if your short position incurs a daily negative swap call, especially if you plan to hold it for days or weeks.